You open your phone. You buy a trending stock. The bright green numbers deliver a dopamine hit that completely bypasses your logical brain. You feel invincible. But are you actually making a rational choice? For 99% of consumers, this is a trap. It feels like free money. You think you are participating in a highly sophisticated, modern financial system, The reality is much darker. Why does this always end in tears? Your brain is being hijacked. It is a very old trick. This precise mechanism of wealth destruction was mathematically perfected in the year 1720. It was an absolute bloodbath. Are you ready to see the blueprint? London, 1711. The British government has a massive problem. Decades of expensive wars have left the entire nation drowning in unprecedented, suffocating debt. Anyways, enter John Blunt. Who exactly is this man? Blunt is a master marketer. He is a financial engineer. He understands human greed and behavioral manipulation better than anyone alive in his era. Blunt creates the South Sea Company. How does he trick an entire empire? The scale of the debt was staggering. £31 million was owed to various disorganized creditors across the entire British Empire. The government was desperate for a clean, unified solution to avoid a catastrophic default. Blunt approached the state with a beautifully deceptive, elegantly structured financial proposition. How do you solve a £30 million crisis? The South Sea Company would assume this entire, massive debt burden off the government's balance sheet. In return, the government would pay the company a steady, guaranteed 5% interest rate every single year. The company would then aggressively issue new shares to the public to fund this massive buyout. The public believed they were buying into the infinite, exotic riches of the South American gold trade. They were actually just buying repackaged, boring government debt. The underlying asset was incredibly dull. The marketing layer applied thickly on top of it was pure, unadulterated financial seduction. How do you sell boring debt to the masses? The pitch is remarkably simple. Blunt offers to take over the crushing war debt in exchange for exclusive trading rights. This is a debt-for-equity swap. What does that actually mean? It means trading guaranteed debt. It means swapping loans for shares. You are exchanging a fixed government obligation for partial ownership in a highly speculative, unproven business. On paper, it looks brilliant. But what is the actual reality? The trade routes are blocked. The Spanish Empire heavily restricts any real commerce in the region. The South Sea Company is barely making a single penny of actual, tangible profit. So Blunt aggressively pivots. What is his new product? He stops selling colonial trade. He starts selling pure hype. The underlying asset is completely worthless. But the marketing narrative is utterly intoxicating. Blunt is selling a dream. Does this business model sound familiar? Blunt needs the price to climb. He needs relentless momentum. He begins aggressively bribing prominent politicians and lords with free, unearned shares of his company. He secures a massive victory. How high does the corruption go? King George I joins. The king becomes the company's governor. This is the ultimate, undeniable celebrity endorsement that validates the entire shady enterprise. Suddenly, everyone wants a piece. What happens to the stock? It begins a vertical ascent. It goes from £100. It rockets past 300, then 500, and eventually crosses the £800 mark. The entire country loses its mind. Who is actually buying this stock? Politicians and farmers are buying. Maids and famous poets are throwing their entire life savings into the wildly inflated market. This is pure behavioral economics. Nobel laureate Richard Thaler extensively studied how human beings consistently make highly irrational, emotionally driven financial choices. Thaler identifies this as herd mentality. How does the herd infect your brain? When your neighbor gets rich? When they do absolutely nothing. Your logical defenses completely collapse under the crushing weight of your own jealousy. You experience pure, unfiltered FOMO. How much would you risk to belong? Thaler also coined the concept of mental accounting. This is how your brain categorizes money differently depending on where it came from. When your stock portfolio goes up, you view those paper gains as house money. You treat it with significantly less respect than the money you earn through hard, physical labor. The citizens of London were suddenly rich on paper. They started spending lavishly. buying carriages and estates on the assumption that the South Sea stock would never fall. They were mentally accounting for wealth that had not actually been realized yet. What happens when the house money suddenly vanishes? Even the smartest man fails. Sir Isaac Newton is brilliant. He invented the complex mathematics of calculus and mapped the fundamental laws of gravity. He is an early investor. What does the genius do? Newton watches his stock double. He takes his massive profit. He cashes out of the South Sea Company and walks away a very rich man. It is the perfect trade. But what happens next? The stock price keeps climbing. His friends are getting phenomenally, disgustingly rich, right in front of his eyes. Newton's brilliant, analytical brain cannot handle the agonizing psychological pain of missing out. So, he jumps back in. When does he buy the stock? He buys at the absolute peak. He throws his money into the market right when the euphoria reaches its maximum, unsustainable limit. This is the ultimate proof. Financial bubbles prey entirely on your human emotions, not your intellectual capacity. How much does Newton lose? He loses £20,000. That is the equivalent of millions of dollars in today's modern fiat currency. He later famously states that he could calculate the motions of heavenly bodies, but not the madness of people. Are you smarter than Isaac Newton? The hysteria creates bizarre mutations. The market becomes a casino. New joint stock companies are launching every single day to aggressively absorb the overflow of greedy capital. One company promises perpetual motion. What is the craziest one of all? A man founds a completely anonymous company. It is literally registered for carrying on an undertaking of great advantage. But nobody is to know what it is. People blindly throw money at it. The founder raises thousands of pounds. He boards a train and vanishes forever. This sounds completely absurd today. It sounds like primitive stupidity. But is it really any different from buying an anonymous digital token based on a cartoon dog meme? Human nature never actually changes. When does the music finally stop? Let us examine the psychology of the crash. Why didn't anyone see it coming? It comes down to a concept called the greater fool theory. This is a recognized economic principle stating that you can make money on an overvalued asset as long as there is a greater fool willing to buy it from you at a higher price. Every single investor in London believed they were the smart one. They believed they could sell to the greater fool right before the inevitable crash. But John Blunt's scheme meant the company itself was the final, ultimate fool. When the company's cash dried up, the entire pyramid collapsed. How did he accelerate the destruction? The scheme has a mathematical flaw. Blunt runs out of buyers. He needs fresh capital to keep the artificially inflated stock price from completely collapsing. So he does something reckless. What is his fatal mistake? He starts lending people money. He uses the company's own cash to let people buy more of the company's stock. In modern finance, this is called margin lending. What makes margin lending so incredibly dangerous? It means borrowing cash to gamble. It artificially inflates market demand to dangerous, highly unstable levels built entirely on debt. But when the loan comes due, you have to sell the asset to pay it back. What happens when everyone sells? In the summer of 1720, the grand illusion finally shatters. The margin loans come due, and desperate, over-leveraged investors start selling their shares simultaneously. The stock price violently drops. What does a margin call do? Margin calls trigger more selling. It becomes a vicious, unstoppable cycle of panicked liquidation that wipes out all the fake wealth. The stock price plummets from £1,000 back down to a miserable 150. The spectacular bubble finally bursts. Who pays the ultimate price? Thousands of families are ruined. The British Parliament is forced to aggressively intervene and pass the Bubble Act of 1720. It is the craziest wipeout ever. The wealth did not simply disappear. Where did all the money go? It was cleanly, systematically transferred. It moved from the emotionally driven late buyers straight into the pockets of the early insiders. The South Sea Company was a machine designed to extract wealth from the impatient. How is this happening to you? Let us reconstruct your path. You download a shiny brokerage app. You see a meme stock or a digital currency rocketing straight to the moon. You feel that exact panic. What does your brain scream? Your brain screams at you to buy. You even use the app's instant, frictionless margin feature to buy vastly more than you can afford. The highly publicized democratization of finance is actually just a mechanism making you poor. Why does Wall Street want zero friction? Because friction forces you to think. When trading is completely effortless, you stop analyzing the data and start purely, emotionally, reacting. You become the necessary exit liquidity for the sophisticated institutional investors who got in early. You are funding modern-day John Blunts. How do you break the cycle? Here is the bitter, counterintuitive twist. Infinite information does not protect you. It just accelerates the terrifying speed at which these bubbles destroy your hard-earned wealth. Newton had the best analytical data. He still got completely crushed. Your phone gives you 1,000,000 data points. But your brain is still wired for 1720. You open your phone. You buy a trending stock. You do it just because the green numbers deliver a frictionless dopamine hit to your brain. But this time, you know exactly who's holding the bag.